Do you know what you're going to be doing, or how your health is going to be, or financially how you're going to be at the age of 71?
No,
Probably not, right? Like you'll have a general idea. You know what you're working towards,
right.
but you don't know for certain. So why don't we cover you right now for what you know you need to cover, which is your family. You want to make sure you have a certain amount. You may know what type of debt you want to take care of, whatever it may be.
Thanks for joining us, guys. You got your host here. You got John. You got Albert. And we got a special guest. Super Bowl champ, Solomon Miller the first.
Oh, wow. Give me flashbacks. Give me flashbacks.
King Solomon.
Thanks, guys. I totally appreciate it.
So we're going to go get into it. We're going to go more on client questions and client scenarios. So we're going to go with Solomon's first question. So our first guest will be a question based on his scenario. He's dealing with a client. So fire away.
Excellent. I came across, thank you, by the way, for having me here, you guys. I really, really appreciate it.
Yeah.
But first scenario, I met this gentleman named Eric Griffin. He's live in Florida. And he mentioned to me that I called him up and said, hey, I'm responding back to your request for life insurance. He said, I already have life insurance. I said, excellent. I said, how much insurance do you have? He said, I have one policy for $500,000. So he went into slight details. I said, that's great. I said, is that what your job? Is it term? He said, I'm not sure. It sounds like it's a term. I think you're right. Okay. I said, okay, if you have insurance, what's the purpose of me calling you? How can I assist you and how can I help you? He said, well, first of all, he said, I don't have time. I said, you know what? You don't have time, but you send in a request. Tell you what, you live in Tampa, right? I used to play for Tampa Bay Buccaneers.
Hey.
Find a connection, right? Because he's about to diss me. I found the connection. Before you know, we started talking. He opened up and said, okay. He said, I need something that I can bring in money on a regular basis. Okay. As I get older, I'm 53 years of age, been in my job for several years. And I'm just afraid of just not outliving my money. I said, so I'll tell you what, have you heard of annuity? He said, I'm new at all this stuff. So I knew I had a journey on my hands. So I'm thinking okay. So you ever heard of annuity that you put in $10,000 or $20,000? Minimum is $10,000. He said, I probably can do $10,000. So I said, okay, that's good to know. If you're index universal life insurance. No, I'm new to all this stuff. So my job is kind of to place him where I feel fit for him based on his novice experience.
Right.
Can you guys help me here?
Okay, so let's do a recap. We got a man in his 50s, right? 53.
Yes. Yes.
Mm-hmm. Has some life insurance, already has $500,000 policy. But you got this client, they requested information, so they're still confused about their finances.
Correct.
But now he's talking more about what do I need to do for retirement? What should I look for in retirement? And we're going to run into a lot of clients that way. They're looking at their job placement. They feel like the inflation's kicking in. They literally in the back of his mind, he's thinking, I might outrun my money. I could probably get by right now while working, but what do I got to do going on for my retirement? Got some money set aside. I could put some money set aside. Where do I go?
Mm-hmm.
Okay, so my first inkling on this is good. So I would ask more questions on, okay, are we looking to protect family members? Do you have dependents? Do you have a mortgage? Do you have young kids? Okay. Do we need to look into a life insurance where we need to protect something? Or are you looking more on to you? What do you have set up? If you stop working right now, how are you getting by? If I was to ask you that question, then what do you feel like the client will say?
I feel like he was saying pretty stable. I got a daughter in college.
Okay.
They pretty well off. I would like to protect them and also protect my home. If I live in an apartment or a house, I want to make sure I have enough capital to cover all those areas. Okay. That's what I think he would say. How do I go about that?
Right. So now we got to look at it. Do we want to do an IUL? Do we want to set up something for a tax-free retirement for him? Or does he have enough funds already for annuity? Mm-hmm. So we're looking at it 53. Maybe he's got another 10 years, 12 years to work until he retires. So my first thing is, if we do an annuity, if you throw $10,000 into annuity and let it grow in 10, 12 years, how much do you think that realistically that'll yield? That'd be enough for retirement?
Well, depending on what type of product they're going for, because some are built more for accumulation, some are built more for liquidity, so they can turn it on sooner.
Mm-hmm.
Some are built kind of to be a hybrid. So it really depends on what you're focusing on, but starting at $10,000, $20,000, if you're in your 50s, it won't be enough for you to retire and live off of, but it's still something, and it actually could be a supplemental retirement income. So as long as you phrase it properly and help them understand, it's not going to solve everything for you, but you're going to get Social Security. If you have a pension, if you have any other retirement plans, this could be a way to supplement your retirement.
Right.
If you have this money, you don't know what to do with it, so it's going to be sitting around anyway, or you want it to work for you, this might be a fit. Okay, so as long as we set the proper expectations for the client,
Yes.
I mean, we just can't be like, oh yeah, put this 10,000 aside, you're set for life.
Yeah.
It's all about setting it up properly.
Right. Set the table. Yeah.
And then also we're not retirement planners, but we have a little bit of information about how retirement works. You can also tell the client, have you ever gone into your Social Security? Have you looked in, go to ssa.gov, create your account, look into, when you choose to retire, how much do you plan to get? And then sometimes they'll see, okay, I got enough quarters, maybe I'll get 2,000, maybe I'll get 1,500, maybe I only get 1,000. So now they have an inkling of like, okay, well, if I go right now, I'm going to get 1,500. How much income do I need to support myself and then a steady income? Okay. So Tom Hegda always says the best ways to like have paychecks and playchecks is to have annuities or a source of recurring passive income you don't have to worry about. And so that'll be a comfortable retirement for him. Right.
Plus, if you actually get them to go on the SSA website, Social Security Administration website, and they actually take a look at if they retired at this age, here's how much they get. If they retire at this age, here's how much they'll get, so on and so forth. If you actually do that, then you can actually ask a question. So when were you planning on retiring?
Yeah.
Because originally they'll be like, as soon as possible, man. I hate my job, or I don't want to work, or whatever it is. But then you'll say, okay, if you look at 60 or 62. Will that be enough for you to live off of for the rest of your life if you don't have other sources of income? And then it makes them really think, because I just want to go back to your original question, because originally he said, like, I'm not really interested, or I already have it taken care of, or whatever. Good job if you continue to push forward and actually getting through it and being like, well, why'd you fill this out? You filled this out for a reason, and keeping the conversation going so you can get to this point to actually educate them about it. Because I think a lot of agents would just be like, okay, have a good day, and then they hang on. Which, look, that's okay if you got a ton of leads.
Yeah.
Because you shouldn't waste time with people like that if they're not interested. But they filled it out for a reason. Who knows what, maybe you caught them at a bad time of the day. Maybe they were busy and there was something it just wasn't that important to them at that moment. And then sometimes we let that go, and then we miss out on opportunities, not just for us to make our commissions, but more importantly, they filled it out for a reason. At some point, there was some type of pressing need, and then it just maybe dissipated at that moment.
Yeah.
And then you kept it going, and then you're able to at least present some solutions to him. What he chooses to do with it, that's on him.
But you're the first in line of a possible resource for him because he's lost.
Yeah.
Right. So then when you come through the realistic standpoint, okay, if you do want to set aside some money, if you can, then we really got to attack the thing now.
Right.
Right. So if he wants a little bit of life insurance, most likely his $500,000 is going to be a term. Right. So if you want to go into an IUL, you just got to let him know, okay, you need to invest money into this IUL to make it worth it. I would look into like FNG. I like FNG because they have an IUL with living benefits. Okay, so you have the insurance, you can overfund it in case something happens to you. You get terminally ill, chronically ill, critically ill. You can tap into your money. So it's going to help you out in case you get disabled, right? And then more importantly, you can tap into the money whenever you need to.
Right.
But I would logistically say, like, look, this is not like a $50 plan.
Right.
Right. If you want to set up for retirement now at 53, you got to look at 200, 300, 400, 500 to make a dent in.
Right. Okay. Good to know. Thank you.
Yeah. And, I actually been running into a lot of these clients because I don't know, the leads that I've been getting recently, they've been consuming a lot of insurance information through social media. So they watch people talk about your own bank. And you can build up all this non-reportable tax-free income for the future, which theoretically it can do that. That product does do that. But the thing is the way that they set it up. So some of these questions that I get from these clients are like, what's the cheapest IUL I can get? Right. And I'm like, okay, I'm like, do you understand how an IUL works? And then they'll be like, yeah, it's one of those things where you can pull money from it later, right?
Right.
And I'm like, yeah, that's the general principle. But let me explain to you how it works. So I break down the three parts: the administrative fees, that's built in. That's to keep the company lights on, to pay, process your application, pay the agent, all the other stuff. So that's already, we can't do anything about that. Second is the cost of insurance. The cost of insurance, it depends on how much coverage you want. So if you want to do more, then the cost of insurance is going to be higher. If you want to do less, cost of insurance will be lower based on your age, based on your health, that kind of stuff. And then the third component when you pay a premium is you got the administrative fees, you got the cost of insurance, and then the final part goes into the cash value accumulation.
Right.
So I'm like, we can keep it cheap for you, but the thing is, if your premium's smaller, then it's lower, then you won't have very much going to the cash value accumulation, which at that point you're barely just paying for the cost of insurance, and then you're almost better off just getting either a whole life coverage or a term policy if you're looking for a large amount.
It's not enough
because it's counterproductive. So I'm like, we can set it to whatever you want. I'm like, my goal is not to get you to buy a policy of a certain dollar amount.
Yeah,
it's to kind of ascertain your needs, figure out what your long-term goal for is this, if it's more important for you to have coverage or it's more important for you to build up cash value. Right. And if you're looking to build cash value, you can overfund this policy. And if you overfund it, that's going to build up on the back end for you. It's not for the insurance company, that's for you. So if you're asking the question, what's the cheapest, then maybe we need to try to make sure you understand how this IUL works, because this may not be the right product for you.
Because at the end, their mind state is, what's the cheapest where I can get the most money back? It doesn't work that way. What you don't pay into, what you don't build, what you don't invest on, it won't return any Super Bowl, super lotto winnings type, right? So it doesn't make sense. But going into a specific detail, so if they're looking for that, they're a little bit older, right?
Correct.
Certain policies out there has a minimum life insurance. Okay, so Mutual of Omaha and FNG are great at that, because FNG, you could do a patch setter product. Minimum on that is $50,000. And so even if they're older, you can get the lowest $50,000 life insurance cost and overfund it. Mutual of Omaha, their IUL Express, if you do a non-EC solve, you can go $25,000. So you can buy the lowest amount of life insurance and overfund that. Okay, so anything higher builds up to their cash value. But the biggest risk, though, if they're in their 50s, you just don't have enough years to compound.
I see. Yeah.
If you plan to retire in your 60s, early 60s, mid 60s, 65, you got 15 years max. How much can you really compound in 15 years versus somebody in their 20s or 30s that has 30 plus years versus somebody that's 5 that has like 55 years, 60 years in. So it's all about just being realistic.
Realistic. Yeah.
What's actually worked for me recently too is like, I'll talk to some clients that are in their late 40s or 50s, which they're not the ideal IUL client in terms of building cash value. Like they could be a very good IUL client if their biggest concern was to have a permanent coverage and then still build up some cash value, but cash value is not the primary concern. But so the thing is, like, when those clients call and say, or even if a client's younger, their budget's just very small, and they're like, hey, I was watching these IUL videos, I want to be able to build cash value, and I'm like, okay, great. So, I mean, I'm here to work for you.
Yeah.
So, did you have something in mind in terms of how much coverage you wanted? Did you have something in mind in terms of how much you want to set aside monthly for this? And if they're like $100,
yeah,
right, or like something that I already know, because from experience, I already know it's not gonna build you a ton of cash value, right? Sometimes I'll be like, okay, then why do you want this, and blah blah blah. So kind of ask follow-up questions to see why they want what they want, and then sometimes I'll even go through the whole rigmarole of just running the illustration for them. I'm like, cool, I'm here to help you out. I'm just your broker, so let me see what I can do. Put together the illustration. I'm like, let me email this to you right now. I'm like, let's look at the numbers. I run through. I'm like, here's how it works. Here's how much you're putting in monthly. Here's how much the minimum coverage has to be in order to avoid becoming a MEC, a modified endowment contract. So that's how you get these, tax benefits on the back end, tax advantages on the back end. It's an insurance product, so that's how you get around it. So then I'll be like, all right, let's look at the cash value. Let's look at the increasing death benefit. I'm like, was that really what you're looking for? And they're like, yeah. And then you can tell the disappointment
based on the price, based on what they're seeing, based on the cash value.
The cash value won't be enough for their retirement. So I'm like, yeah. So I mean, based on what you told me for your budget, I mean, unless you're able to put a substantial amount more premium into this, the thing is, it probably won't build up enough of a substantial substantial cash value for you, because it requires two things. It requires either you have enough premium, or you have enough time for it to compound. And and you're by no means old, but you're also no spring chicken, so you don't have enough time for that to continue to build up. And they're like, yeah, that makes sense. I'm like, however, have you heard of a term with the return of premium? And then I'll pivot over to that, and
Mhm.
I'll go to America most of the time with CBO. And I'm like, well, with this product, it's a relatively new product. It's going to cover you for the next 30 years. So you know exactly how much you'll be covered for.
Mhm.
Your family's taking care of you, pass away during that time. And here's the best part. If you don't pass away after that time, you can get all of your money back. And they're like, all of it? I'm like, yeah. So it builds up cash value. So you can borrow against this should you really need to. It's not recommended because if you start pulling out from that, when the term is up, if you didn't pass, you won't get the full amount back.
Right.
Mhm.
But it gives you some options and you know exactly what you're going to get given your budget. And they're like, okay, yeah, that goes good. So I think a lot of times these clients fill out the request online, or they fill out the lead, whatever it may be. And they have an expectation of like, cool, an IUL's for everybody. I want to get that. But then it gives us an opportunity to kind of educate them and kind of redirect them based on their financial situation. So I'm like, hey, look, maybe this isn't the right plan for you, but maybe this term of return of premium is, or maybe this whole life is, or maybe this term is, or whatever it may be. Maybe an annuity is because they have existing lump sum of money, but an IUL, they don't have enough time to build up cash value.
Yeah, it's really good too, because like it's the best of both worlds when you sell a cashback option or a term with the return of premium. Because sometimes these clients, they want these investment products, they want to put in money, but they don't have a lot of money, so now they have to lower their face amount. Well, if they lower their face amount, but they have young kids, they have a mortgage, they have dependents, that's not enough life insurance. Right. We're thinking about the future, but if they die tomorrow, what if you did the 25,000 or 50,000 FG product? They've spent 400 a month on it. They're only getting 50,000. If they die tomorrow, they're getting paid 50,000. Well, what happens to the kids? What happens to the house? What happens to the mortgage? Right?
Yeah.
So it's a good mix of both worlds, because you sell that product, now they have a bigger face amount, and they still get all their cash value back just in case anything happens or nothing happens in 20, 30 years.
Right. And, obviously people can go and invest, and they can get much higher yield stuff, but they're taking a risk.
Right.
But, what I think has really worked for me, it's when clients are looking for an insurance coverage, the thing is, the psychology of a lot of these buyers is they recognize that, yeah, it could help them. They need this coverage. It could build up some cash value, but they're just trying to hope that they're not getting a worse off deal. So that they want to get the best deal possible.
Mm-hmm.
So that I think the reason why a term with return of premium is so effective is because I'm like, hey, so you're covered for X amount for this amount of years, gives you more bang for your buck than if you get a whole life plan. There's more coverage. And then at the end of, if you're 50 right now, you'll be 80 by the time this is done. How long do your parents live till? Right. So if they say they didn't live to 80, then, it's within reasonable expectation that they may not live that long either. So they may be covered. So you're covered for that full amount during the next 30 years. And here's the best part. If you don't pass away, you get all of your money back. I'm like, so either you're covered, your family's going to receive this money, or you'll get all your money back. You can't lose.
Right.
And I always use that phrase, you can't lose. And then they're just like, okay, yeah, that sounds good.
Yeah. Because I'm pretty sure, you do the math too, right? Like, let's say they're paying $200 a month, $2,400 a year, multiplied by 30 years. So they still get a substantial amount, which sometimes is more than what they'll get with their cash value from just the regular IUL.
No, I got a question with that term, CBO. Mm-hmm. They want to accumulate, or they want to add more, higher premium, what they're normally paying. Can they do that?
It's not a flexible premium, so you can't add after the policy's already been issued, but you could take out another policy if the client wants to have more coverage and they want to be able to have more of this type of product.
It's more like a setup, like a fixed guaranteed.
Right. A lot of questions occur that way when I talk to clients as well. I want to blast it out there for everybody to be on the same page.
I actually went over this, about not kind of stepping too much over here.
No, we're good.
But Solomon and Rosalind were in here going over this last week. And actually, to go further on the CBO training, or the term of return of premium. I explained to them, you cover for the next 30 years. After that, you get all your money back. You can't lose. I'm like, in addition, here's what happens afterwards. You're going through your scenario. If it's $200 a month for the premium times 12 months, that's a year. You'll pay $2,400 into this for the next 30 years. Here's how much money you'll have paid into it. Here's how much you'll get back. And I'll actually calculate with them. I'm like, here's how much you paid into it. After 30 years, here's how much you'll pay into it. And if you don't pass, you get all this money back. And then they're like, okay, that's cool. And I'm like, let me take it a step further. Now with this, what's 2,400 times 30?
I think it's 72,000.
72,000.
I'm using my calculator, bro.
Yeah, I just want to just
I think I'm calculating right.
I think that's right. I just don't want to throw out a wrong number there, but in my mind, this calculation
72,000. I'm good.
All right.
Hey, my math's still mathing.
So I'm like, after this, with this $200 a month premium, at the end of the 30 years, you'll get $72,000 back.
Right.
So at that point, you can reevaluate where you are financially at that point. So, if you're 50 right now, you'll be 80. So at 80, you can decide you get 72,000 back. You can, number one, you can take this money and you can just use it apply it towards your funeral expenses. Keep the rest of the cash.
And question on that: do you pay taxes on that 72 back?
Tax free.
Tax free.
So
Tax free.
I'll throw that. And all insurance products is tax free when you receive the cash value, or if your beneficiary receives death benefit, tax free.
If you guys enjoy, I'm saying it too many times.
Thanks for joining us so far. That's all I remember.
We can continue to share with other people. We probably need to redo it, right? Hey guys, thanks for joining us. If you guys have found this stuff helpful up to this point, or you guys would like to see some other stuff,
Please like and subscribe and create a comment so we can cover that next topic.
And continue watching the show.
so you can either keep the $72,000, apply that towards your funeral, or what you can do is you can take a portion of this $72,000, take out another life insurance policy, just enough for your funeral, however much you need at that point.
Yep.
Because your financial needs will probably change, right?
Right.
And they'll always say, yeah, I don't know what's going on.
Yeah.
Right. And then I'll say, and the final option with this is, let's say you have your funeral taken care of, you're in a good financial spot, everything else is taken care of, you don't need any more life insurance. At that age, if you're retired, we can take the $72,000 or however much that return of premium is, and we can roll this into an annuity and give you a supplemental retirement income on top of whatever you already have. And then they're like, oh, yeah, I didn't think about that. I'm like, yeah, so this way it provides you with the most amount of options. By the time it comes, you'll be covered for the next 30 years. You can get all your money back, so you can't lose. You can get this money back tax-free. You can reevaluate and reassess your financial situations when the 30 years is up.
Yeah.
And then they're like, okay, that makes sense. And then, so, I mean, you kind of play it, because right now they don't know financially where they're at. The thing is like, how do you know what you're going to be doing 30 years from now? So why don't we set you up with something that provides you value now and takes care of your immediate insurance needs, but you'll be able to figure out what you want to do at that point when the time comes.
I got a quick question. Now, what age group would you recommend applying that policy to and pivoting to annuity later?
Anyone that qualifies. Anyone that qualifies, because I've talked to 20-year-olds and I applied that same logic, because I'm like, you don't know how your 30s is going to be. If you're in your 20s, like, us from personal experience, right?
Yeah.
When we're in our 20s, we had no idea. We thought we were going to be young forever.
Right.
And we thought we were going to be invincible, continue to hit the clubs, do whatever we want to do. And then when you get to 30, you're like, it's a different phase. Like, I'm thinking differently now. Yeah. And you hit your 40s, is a different phase. I mean, so you never know. It's not predictable. So,
well, what about age 41, for example?
That's good.
10-year annuity?
No, but you got to understand, you can do 15-year, 20-year, 25-year, 30-year annuity.
Yeah.
I mean, return to premium.
CBO.
Mm-hmm.
So I paint the picture for them. So I'm like, if it's a term with a return of premium, I always try to show 30 whenever possible.
Mm-hmm.
So I'll be like, all right, so if you're 41 right now, Solomon.
Okay.
If you're 41, I'm like, do you know what you're going to be doing, or how your health is going to be, or financially how you're going to be at the age of 71?
No,
probably not. Right. Like you'll have a general idea. You know what you're working towards,
right? But
you don't know for certain. So why don't we cover you right now for what you know you need to cover, which is your family. You want to make sure you have leave a certain amount. You may know what type of debt you want to take care of, whatever it may be. Let's get you the appropriate amount to cover you for the next 30 years. And then at 71, you can pay for your funeral with this. You can take out another policy. And what we're hoping is you're good. We can take this and roll into an annuity. Supplemental retirement income. Mm-hmm. So then gives you the most flexibility, most options, right?
True.
So
going back to that question, not a question, but you made a statement about, in their 40s, it's not really the best suitable client to do an IUL.
Probably not.
Right. Not for the normal premiums. Yeah. Clients would.
If this guy was loaded and he owned his own company and had a ton of money to throw towards a premium, for sure it could work.
Yeah, and we go through training. We've gotten some IUL reps, and we've asked that same question: what is a good age if you really want to throw a lot of money into an IUL? Average age would be like somewhere between 0 through 20 if the parents are buying for it. But typically for an adult, like 20 to 35 is a good age. Yeah. Do you agree?
Yeah, no, I think that's when you can really maximize the time for that compounding interest.
Mm-hmm.
There's no price.
But yeah, because ideally, like at 20, $100 a month plan or a $200 a month plan can go a long way.
Right.
At 50, not doing much. Right? Their cost of insurance is eating that up instead of the cash value.
Yeah.
In your 30s, you can get away if you're settled, you have a decent income. You could throw in 300, 400. It'll make a big impact.
Yeah, but just going off my example from yesterday, lady wanted to get a policy for her 5-year-old son. Okay, so it's $50 a month for the premium, so it's $600 for the year. But the thing is, because he's so young and he has so much time for that compounding interest, so this is not a guarantee, but this is at the current illustrated rate of, it was like 6 point something percent.
Round up to 7. I know it's like 6.9 now.
Yeah, something like that. So it's just compounding over time. So the thing is, by the time he was like 65 years old, by the time, if he didn't touch the money, it was the average return of 6 point. It continued to stay somewhere around that type of return. He'll have over $700,000 in life insurance, and also $700,000 in cash value, and he can access tax free. Right. So I mean, all for $50 a month, because it's just either you got a lot of money you can throw at it, or a lot of time. And a 5-year-old, he has time to
let it continue. 50 to 60 years of the compounding.
Yeah.
So it just keeps going up. That's what's also a side point great about the annuity. I mean, the IOL, even when you borrow the money from the cash value, the interest rate still grows, assuming it's not borrowed. It goes in the accumulated value. So it just keeps on growing for you.
So you get both, right?
Yeah.
If it's increasing.
If it's increasing, yeah. So you still have the death benefit plus the cash value combined. It's not a bad thing. So you can set it up if they're 5, 10, 20, 30 years down the road, they can continue to take lifetime withdrawals. If there's still some cash value in it, the policy's still around, and there's still the death benefit plus whatever remaining cash value.
So just to clarify, so in my situation yesterday, at the age of, for that particular scenario, he was 5 years old. At the age of 65, he'll have roughly about $700,000 in increasing death benefit starting from the $50,000 in coverage.
Okay.
And he had about $700,000 in the cash value account as well.
Right.
So if he passes, he can get both. The family can get both.
If he never tapped out the 700,
right. If he never borrowed anything along the way,
he's going to get the 700,000.
Oh, so that's like 1.4 million in value.
No. It's one or the other. It's the same. It's the same. The cash value and the death benefit on the far right is what it is. No, let's say they took out 600,000.
Yeah.
There's 100,000 left plus the 50,000 of the death benefit. That'll reflect that.
Oh, so you get
150.
Yeah, that's what I was thinking. So you get the death benefit minus whatever withdrawals that you've taken.
Yeah. So it's combined from the death benefit and the cash value whenever the things happen.
But one of the cooler aspects of an IUL too is just if you borrow money against it, it forms an arbitrage, so it still continues to accumulate value at that, as if the money was still in the account.
Right, because it's not like essentially you're not really borrowing from your policy, you're borrowing from the insurance company. They just make a note, and then they have a note on your policy. This is how your policy should be growing, and then they take that out of it.
Well, you're technically borrowing against your own policy, so the thing is
collateral in a sense.
And hence, this is your own bank. All concept.
You're your own bank, and instead of paying someone else's interest, so this is the concept of being your own bank. Instead of me getting finance on a car or finance on a house, I'm going through Rocket Mortgage. I'm going through Chevrolet dealership financing. Well, I'm paying them the 5% to 6% interest. Well, I might as well pay that back to my policy, and it still grows.
Yeah. Instead of paying JP Morgan Chase, you're paying JP Morgan Albert Lau.
There you go.
There you go.
And then, I mean, in reality, in the future, like if you really want to get into what they say generational wealth, this is where a lot of people are, they're creating a living trust. The trust is the beneficiary. And then whenever a new family member is born, they buy a new policy and an IUL on the new members. Anything happens, it gets refunded back to the trust. It's an ongoing family bank at that point.
Nice.
But somebody got to start it off. Right?
Yeah. So, I mean, it's a little bit, it's not the most simplest of plan because, you got to kind of have a pretty good understanding of how it generally works, and then you kind of mess with the design. So, I mean, if for anyone out there watching, if you want to get started with these, I mean, ask your upline for help. You can ask the AMS department. Reach out to the resources. I mean, something that you can also, if the client says this is absolutely what I want, I know about it, and you're not quite there yet in terms of understanding how the product works, set another appointment. Say, okay, just generally, so I can ask some general questions. Like, I'll get someone. Let me research that for you, and I'll come back and bring an illustration.
So we got a few more minutes. I know we spent a lot of time on Solomon's question, but does anybody else on the chat have other questions? Kuhn, Ray, Andres.
You guys have any questions for us?
So we're gonna wrap it up. We're gonna continue for next week. We're gonna have a lot more detailed client scenarios. We got somebody that chatted. I don't even know what to ask yet. It's all right, Ray.
That's a
We'll
good
get you
point.
rolling.
So, well, I mean, I think just kind of you've been on the live dial. So, I mean, I think that's a good way for anyone to get started, because a lot of times we overcomplicate the process when we first started, because we're just thinking like, what if this happens? What if this happens? What if this happens? And the what if game starts consuming our thought process. And just you get on, you listen to Terrence, you listen to JP, you listen to myself, you listen to John, you listen to whoever, and you're like, oh, these guys aren't doing anything special.
Oh.
And it really isn't anything special. It's really just a lead fills out a request, we give them a call, we get them on the phone, and then we ask them what they want.
Yeah. Keep it simple. First things first, make sure you're licensed, make sure you have your carriers, you're appointed, and then call anybody and everybody at that point. So you call your leads, you call your contacts, you call a warm market, however you want to do, but you want to have conversations about life insurance. Once you make a connection, then you got us to help out. We got the client scenario. We got to start with a conversation about someone needing something from us first.
Oh, I just want to make that one point, but since we're on this question, like Solomon's client, if he says like, oh yeah, no, I don't really need it anymore. So sometimes we just got to keep the conversation going, because it's not even that, it's sometimes it's just, you don't even know what you don't know. Right. So the client could need something, and one of our products, one of our solutions could have really made a difference in his life materially, financially, but he didn't know what questions to ask. So then, by you continue to keep on the phone, keeping the conversation going, asking the right type of questions, then you can start drawing out of them, like, what's your biggest concern? Like, what is it that when you filled this out, like, what were you thinking? Like, who are you trying to cover? Like, what's your situation? All that kind of stuff. So the goal is to try to talk to as many people as we can and help the people that need it.
Yeah. It's like a financial therapy.
Yeah, it is. Can I ask that just a teeny bit?
Please do.
I met another person after that phone call, and I was on the road. I'm like, wow. The lady said, well, I had to follow up like 3 times and so forth to get to her. When I did get to her finally, she said it's best time to reach me that night. So I called her in the evening time, and she said, hey, I don't know anything about this business, anything about insurance. I would like to know more. I said, okay, can you send things out to me? Can you send me some information? No, I can't do that. I really can't. It's more like a Zoom, more like I can give you scenarios and it's figure out what works for you. He said, well, you know what? I don't know anything about it. It's just selling me now. That's what I don't know anything about it. Help me out. I said, okay, what I can do is go with an illustration with you and present it to you. And that way I email you one. And that way there's a Miracle CBO. And this way we can go from there. So I emailed her some information to get her taste buds going for his information for his insurance. So now I'm in a communication with her. So I got a meeting with her today, if not tomorrow, but I'm going to follow up with her today anyway. But it's a process. It's definitely a process. And I get a learning process. You learn a lot from it. Sure.
I get a lot of clients that way too. Like, what's the insurance? What type of insurance is good? This is why we create social media. We create content. We created one where it's a 3-minute segment of just like what are whole life, term life, universal life. All I do is I send those clients my video. So now it builds credibility on me. It talks about the different types, what's good for you, and then they get to figure out which part it might fall into, and I follow up.
Nice.
So don't be ashamed. I mean, create your own video. We got Bryce at the house. If you want to create your own little audio,
Bryce on the spot.
Back, it creates your social media, and then it creates influence.
Great, thank you.
Yeah. Or I mean, the easiest way is just be like, sure, I'd love to be able to help you, but just so I can, let me ask you a few questions so I can narrow it down, and then I can point you in the right direction.
Yeah.
So that's all the time we have. Thanks for joining us. We're going to have more client scenario next week. We'll see you guys next week.
Thank you.
Thanks, guys. Have a good one.
Hey guys, thanks for watching. If you guys want to subscribe, click here. If you want to watch the next video, click here.